Imagine you're a young Warren Buffett in 1949 reading The Intelligent Investor for the first time. Buffett calls it the best book on investing ever written. Why? Because it taught him the golden rule of investing: protect your capital and grow it intelligently. Fast forward to today, Buffett's net worth is over $100 billion, and he credits much of his success to Benjamin Graham's timeless lessons. So, let's break down all 20 chapters of The Intelligent Investor in under 10 minutes, starting with the basics. Chapter 1: Investment versus Speculation. First things first, are you an investor or a speculator? Investors analyze and focus on long-term returns. Speculators bet on short-term price movements, like gamblers at a casino. Warren Buffett followed Graham's advice. He ignored market noise and focused on owning companies with great fundamentals. Remember, the stock market is not a lottery, it's a wealth-building tool if used wisely. Chapter 2: The Investor and Inflation. Inflation eats into your returns like termites on wood. Graham advises investing in assets that keep pace with inflation, like stocks of companies selling essentials or even real estate. Buffett's example? Coca-Cola. Its products have stood the test of time, and the company adjusts prices as costs rise. A perfect inflation hedge. Chapter 3: A Century of Stock Market History. Graham walks us through decades of stock market data, emphasizing that markets are cyclical. The key? Don't let bull markets make you greedy or bear markets make you fearful. Buffett studied this history and learned that market crashes are opportunities to buy quality stocks at bargain prices. As he says, be fearful when others are greedy and greedy when others are fearful. Chapter 4: General Portfolio Policy, the Defensive Investor. For the defensive investor, Graham suggests keeping it simple: a balanced portfolio of 50% stocks and 50% bonds, adjusted occasionally. Buffett's advice to most investors? Buy low-cost index funds. They're like the slow cooker of investing: set it, forget it, and let time do the work. Chapter 5: The Defensive Investor and Common Stocks. Defensive investors should stick to large, established companies with strong track records. Think of it like picking a captain for your team. Choose someone reliable, not someone flashy who might fumble. Buffett's early investments were in stable companies like American Express, proving this strategy works. Chapter 6: Portfolio Policy for the Enterprising Investor, Negative Approach. Enterprising investors have more freedom but face more risks. Graham warns against chasing trendy stocks or IPOs. Most are overpriced and underdeliver. Buffett avoided tech stocks during the dot-com bubble because they didn't meet Graham's criteria. Result? He dodged a massive crash. Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. Graham suggests enterprising investors look for undervalued stocks with strong fundamentals. It's like shopping at a clearance sale: you want quality items at a discount. Buffett did exactly this with his investment in Geico, a company that was undervalued but had enormous growth potential. Chapter 8: The Investor and Market Fluctuations. Here's the famous Mr. Market analogy. Imagine a business partner who offers to buy or sell your shares daily at wildly different prices. Do you follow his emotions or stick to your plan? Buffett's wisdom? Use market fluctuations to your advantage. When prices drop, it's a sale. When they're high, hold tight. Chapter 9: Investing in Investment Funds. Mutual funds can be great, but Graham warns to choose wisely. Look for funds with low fees and consistent performance, not flashy ones promising the moon. Buffett recommends index funds, which beat most actively managed funds over the long term. Keep it simple. Chapter 10: The Investor and His Advisors. Hiring an investment advisor? Graham says trust but verify. Make sure they prioritize your goals, not their commissions. Buffett's advice? Educate yourself enough to spot good advice from bad. You don't need a PhD, just common sense. Chapter 11: Security Analysis for the Lay Investor. Graham simplifies security analysis for non-experts. Focus on earnings, debt levels, and the overall health of a company. Buffett's approach? He calls it buying wonderful companies at fair prices. Deep research is your best friend here. Chapter 12, Things to Consider About Per Share Earnings. Not all earnings are created equal. Graham teaches us to look beyond headline numbers. Are earnings consistent? Are they growing? Buffett digs deep into earnings reports to understand whether a company's profits are sustainable. Chapter 13, A Comparison of 4 Listed Companies. In this chapter, Graham compares companies to show how to identify value and avoid traps. Look at debt, growth potential, and dividend history. Buffett's mantra? It's better to buy a great company at a fair price than a fair company at a great price. Chapter 14, Stock Selection for the Defensive Investor. Defensive investors should stick to a checklist: strong financials, consistent dividends, and a low price-to-earnings ratio. It's like ordering a pizza, you want the basics done right. Index funds fit this criteria perfectly for most people. Chapter 15, Stock Selection for the Enterprising Investor. Enterprising investors can go deeper, look for hidden gem stocks undervalued due to market overreactions. Buffett's investment in Berkshire Hathaway itself started this way, though he later turned the company into a holding powerhouse. Chapter 16, Convertible Issues and Warrants. Convertible bonds and warrants are hybrids, part stock, part bond. Graham advises caution unless you deeply understand them. Buffett largely avoids these, focusing on straightforward stocks instead. Chapter 17, For Extremely Instructive Case Histories. Graham analyzes real-world examples, showing how bad decisions can sink your portfolio. Lesson? Never ignore fundamentals. Buffett followed this lesson religiously, avoiding speculative plays like Bitcoin because they lack intrinsic value. Chapter 18, A Comparison of 8 Pairs of Companies. Comparing companies helps you see the difference between hype and substance. Graham shows how to choose winners by focusing on fundamentals. Buffett still uses this principle, comparing Coca-Cola with its competitors before making a long-term bet. Chapter 19, Shareholders and Management, Dividend Policy. Dividends matter? Graham says companies that pay consistent dividends respect their shareholders. Buffett, however, prefers companies that reinvest profits wisely, like Apple, which grows shareholder value over time. Chapter 20, Margin of Safety as the Central Concept of Investment. This is the cornerstone of Graham's philosophy: always buy with a margin of safety. If the stock is worth $100, buy it at $70. Buffett's golden rule is rooted here: don't lose money. And rule 2? Don't forget rule 1.